Good morning, Anna, and thank you so much. And it's so beautiful, actually, here on Lake Como that people always wonder, can something really go wrong with the world economy when you're in such a beautiful setting? It's a firm yes, especially when you look at banks. I'm delighted to be joined now by Mohammed El-Erian. Mohammed, thank you for joining us. When you look at the banks, I mean, what have we just lived through? Like, it was March Madness, and it took us a while to get through it.
So we lived through a funding crisis that was created because of a loss of trust. Banking is based on trust. And if trust goes out the window, bad things happen. The good news is the flashing red is behind us, but we're now in the flashing yellow phase. We're going from liquidity to capital, and from financial contagion to economic contagion.
How bad will it be? So we talk about a credit crunch. First of all, if there is a credit crunch because lending basically freezes up and a lot of people don't have access to capital and they need it, how long does that take?
So it takes a long time. This is not 2008. 2008 was a sudden stop where things just stopped because the payments and settlement system was in play. This is very different. This will play out probably in the third and fourth quarter, and it will have a long tail. So it is very, very different from what we've experienced before.
Is there anything that policymakers can now put in place to cushion that?
Well, the first thing is to fix past mistakes. This was, as admitted by the Vice Chair Barr, a major lapse in supervision. This should not have happened, but it did happen. So the first thing to do is to make sure that with the existing regulation, there's better supervision. Then there is a potential for some tweaks to regulation, but we must be really careful because if we go overboard on regulation, this will cause banks to be even more cautious.
But what's the next thing to fall? I don't know whether if you look at SVB, but also Credit Suisse, and we understand it was a problem basically run on the banks. It was people fearful about their deposits. Is there something else that could break?
Yeah. So when you have three things coming together, inherent fragility. Both SVB had a balance sheet fragility, and Credit Suisse had a business model fragility that had been there for a long time. Two is when you have interest rates that weren't increased in time and therefore accelerated in a very short amount of time. And then third, when you have amplifiers in the system, you get what we have. In terms of what next, I actually worry less about a banking crisis as much as I worry about the consequences of what we've already seen.
But does something like Credit Suisse, I mean, it's really incredible, actually, the speed at which it happened. And we always know for many years that it had a model problem, but it's just gone, right, in like the space of a week. Could it happen to someone else?
Sure, it could have. I mean, if you lose trust in a banking institution, it is very difficult to save it. I often step back and say, Switzerland's second largest bank is gone.
It's incredible.
One of the 30 systemic banks are gone, and they went just like that. We now heard that Silicon Valley Bank not only lost 42 billion on the Thursday, but was set to lose 100 billion of deposits on the Friday. Things move at the speed of sound. And regulators and supervisors have to realize this because when you have a lapse in supervision, the risks of fragility are very large.
But Credit Suisse wasn't a problem of supervision, right? It was basically that people were feared and deposits were flowing out and the government stepped in. Is there anything in Europe that, again, policymakers can do to try and reassure, or is it a business model problem? Do banks now need to give more for deposits to make sure that people stick and are more loyal with them?
So I think it's mainly a business model issue. They have to safeguard deposits. That's issue number one. Issue number two, we're going to revisit liquidity buffers. We're going to revisit capital buffers because that's important. So it is a business model issue, and banks are going to have to evolve.
Mohammed, when you look at what's going on in the U.S., do you really worry about shadow banking? And again, when you talk about shadow banking, do we have any idea of how big this is?
So we don't. And that's one of the problems, is that the supervisory process and the regulatory process has lagged developments. So what happened, as you know, is that lots of the risks that were in the major banks migrated to the non-banks, and non-banks now operate like some of the major banks. We don't have a good understanding of that, but what we do know is that sudden moves tend to catch people offside. I mean, you and I lived through the October-November drama in the United Kingdom. Who would have thought that the pension system could be, to quote Andrew Bailey, near meltdown? But it happened because interest rates move so quickly. So there are significant fragilities in the non-banking sector, and we've got to figure that out.
But in the U.S., is it the Fed's fault because they were behind the curve in dealing with inflation and then went all guns blazing?
You know, the example I use is how would you feel if you're in a car when there's fog and the driver continues to drive it at maximum speed, And then the fog, because they say the fog is transitory, it will lift. Then the fog thickens. They say, well, maybe it's not transitory, but they continue to drive quickly, and then suddenly they panic and hit the brakes. Do we expect accidents when someone drives like that? Yes, and we've gotten financial accidents. For me, it doesn't come as a surprise at all that the mistake of transitory inflation and the mistake of not moving fast enough to begin with, which then resulted in the massive increase, resulted in accidents. The hope is you don't get a big economic accident.
Right, but so how can they readjust to that, right? So they've made the mistake. What do they do now?
So the worst thing that they could do right now is to say, we have a credit issue coming.
Yeah.
Let's cut interest rates. If they do that, we will end up with stagflation and financial instability. I think President Lagarde was absolutely right when it says monetary policy, interest rates is targeted at price stability, and all the other tools we have, we target financial stability. Do not commingle the two. I think the ECB understand that, but the Fed is at the risk of commingling.
But this is different. This is actually also the argument that Ellen Zentner of Morgan Stanley was saying, is that they have to keep these two separate. It's very easy to conflate them if it infects the economy.
Correct, and the market has already conflated them. The reason why the market thinks that we're going to get a cut as early as June is they believe that the Fed is going to be reacting not to a significant decline in core inflation. That's going to remain a problem, but it's going to be reacting to something else. And I think that would be a mistake.
Mohammed, it does, and I think you were one of the first ones to say, if they go to the 2% target, even 3%, they'll crush the economy. Will they be happy with the 4% inflation? It's also if there's a confounded credit crunch.
So it's very hard to predict this Fed, very hard. They've got the wrong framework. They've got a framework for the world of yesterday, not today. And the decisions aren't consistent over time. So they will have a choice in the third quarter, either crush the economy to get to 2%, change the 2% target, which they won't do because they've missed it so much, or, like you say, live with 3 to 4% inflation, hoping that it's stable, and keep on promising us 2% down the road. I think the third choice is the most sensible one in this world of second best. Whether they do it or not, I don't know, Francine.
But you would do that. Where do you see interest rates in general in the U.S. by the end of the year? No cuts.
So I don't see them cutting. Okay, let's talk about what they should do and what they will do. What they should do is they shouldn't be cutting, unless something that we don't know happens in the real economy. What they will do, I don't know. When you are overly data dependent, and the Fed is overly data dependent, when you're acting with tools that have impact over time, you can't react to every bit of data. You have to have a strategic anchoring, and this Fed has lacked a strategic anchoring.